A very good afternoon to one and all. So to begin with this panel discussion, let's take up the most trending topic when it comes when NBFC is talked about, what comes in the mind is ECL. So I would like to ask all the panelists that what are the key factors that we should include in our audit process to ensure that there is no under or over provisioning or there are no lapses in implementing the ECL framework.
Thanks, Priyanka. I think one of the factors which I consider important for ECL, and we've had 2 sessions talking about ECL, is the fact that it's a provision which is required to be made called expected credit loss. So when it first came in, we did have questions coming in from the preparers saying that I'm giving 1 rupee today and you're asking me to make a 2 paise provision on it. So why should I give that 1 rupee? I mean, that was the questions which initially came, and it took the world about 3-4 years to answer that. And the answer was in the business side itself, that when I was pricing a loan, let's say 1 rupee loan to Priyanka is priced differently and 1 rupee loan to Ashutosh is priced differently, would mean that Ashutosh has that higher probability of defaulting somewhere in the future, maybe not now. And hence I would be charged that much percentage higher than you. That is the concept of ECL. So it's the business's pricing of an instrument which ultimately finds a way into accounting. And the whole IFRS 9, I'll use IFRS India as one for the other. The whole principle of IFRS is based on that. So when it comes to auditing ECL, it's a management estimation after all. I think as auditors, we also need to go a bit into what the business is doing about the whole thing, about the pricing of that instrument. How is it projecting that? I mean, we had Mahendraji saying that I could be a new company with no background history at all. But when I'm a new NBFC, I'm lending my first rupee ever. Kahin pe to I have done some mental calculations of a loss which will occur. And that loss, for whatever reason, so you're not going into IAS 39 to IFRS 9 journey, that loss now needs to be recognized. And as we as auditors, we need to then understand how this whole concept of ECL has come in. Mathematically, it is simple. PD into LGD into AED is the loss which has to come in. Practically, there's always a different way of doing it. So 4 of us over here might have 16 different ways, and each one of them could tick the box that this is proper ECL. The fundamental principle of accounting is consistency. That has to be consistently applied. So you shouldn't have movements coming in quarter on quarter on these concepts. Whatever estimation changes have to be done on a quarter have to be done. But principally, yes, it should remain at least over that cycle of business which one is doing. These are 2 fundamental aspects I feel as auditor of ECL we should know. Of course, we should know the mathematical techniques and all that, but fundamentally we should be aware that this is the principle of ECL and that is how it has got embodied in the accounting standard board.
So, sir, would you like to add anything to it?
I think as Ashutosh has said, in the Indian GAAP, this concept was post facto, post the default taking place. Ind AS is saying it as an expected level. So as Ashutosh rightly explained, it is the expected loss which may occur in the future. At the auditable level, I think RBI is very clear that the way you go about has to be documented, approved at the audit committee level. So practicality is that many companies will have a lot of things which keep on happening. So as an auditor, your interest should be to what extent are these getting documented, consistently applied. And it is not that once decided it will be fixed, you have choice to change it. But the rationale and the basis is something which as an auditor you have to keep on questioning, understanding, and then seeing the applicability on a consistent basis, I think.
So the two bases which Ashutosh and Saurabh sir said was consistency and assumptions which are being used have to be consistently followed, and the basis which Ashutosh sir said ki it is embedded within the loan itself that the ECL would be there. Expected credit loss is within it's a credit risk which is embedded within a loan when we are giving, right? So as I said, we will not go into the calculation, but there are certain assumptions within which, like for each and every 3 parameters, whether it is the EAD or the PD, which is the probability of default, or the LGD. Every organization measures all these 3 parameters at a very different level, but you can always benchmark and have a discussion with the management as an auditor. What are the bases for that, and ensure that the basis is actually rationally been applied and discussed with their audit committee, because what RBI requires is if there is a change in assumption, it has to be documented, approved by the audit committee. And more so over, RBI also wants us as an auditor us to see if there is a management override that needs to be accounted properly. And the minimum of the RBI IRAC norm requirement also needs to be seen. The ECL cannot be lesser than what is the RBI IRAC norm requirement as per what the standard asset and the NPA provisioning. So that also needs to be seen. The stage-wise classification, the general industry standard, which is the stage 1 and stage 2 and stage 3, they built it on SMA 0 would be a stage 1, or SMA 1, 2 would be stage 2, and the NPAs would be stage 3. It is a general practice, but RBI says that more pragmatic and more rational approach can be applied. Some bigger NBFCs are applying, and if that is being applied, rational needs to be seen over there, because it some or the other way RBI expects, and we as an auditor needs to apply our judgment also towards there. So it is analyzing whether the assumptions have been applied rationally and as per the Ind AS, and there is a thin line between expected and an estimated credit loss. So this is called as expected credit loss. The model needs to be adopted consistently. Don't make it an estimation, too much into an estimation by changing it on a quarter-to-quarter basis.
So hearing the view, sure.
Just one more to add on to what Ankush said is that consistency. Yeah, I'd say. So quite a few companies have now moved, and like anything new comes up, it comes with its own jargon. So the new jargon is that I'll do an ECL refresh. So basically all my models and everything, I should test it once a year, whether my business has changed so much that I need to change my ECL completely. So do that ECL refresh once a year. Ideally it could be Q3 or Q2 to do it, not in Q4. So what that does is that it takes away an accusation, if any, of management bias. Jab chaha tabhi I change my estimations to increase or reduce the ECL. So that's a new industry practice which has evolved, and I think it's a good practice that, like, RBI wants policy reviews in any case to be done once a year, so you do this ECL refresh once a year and recalibrate wherever required.
So hearing the views from all 3 of you, so it is good to conclude on the ECL part that there is no fixed or predefined approach that can be considered as a good or a bad, but the key points to note here is the consistency in the estimates that are being considered and to be within the regulatory framework. So moving on to the second question, I would like to ask Ankush sir. So RBI has come up with the harmonization norms for the IRAC. Which is to be brought to the 90 days for the NBFCs. So what are your views on it, and what are the key concerns that could come across in this IRAC norms harmonization, and how it could approach how it could affect our audit approach, and what should we keep in mind?
So just to add on to that, the harmonization is for the middle layer and upper layer is already be in place as per the RBI requirement. For the base layer, they have to harmonize for, as on 90 days, it has to be classified as an NPA by 31st March 2026. So key challenges which we, as of now, as an auditor may face is the system capabilities of certain base layer NBFCs, let's not call it base layers, or certain middle layer NBFCs as well. The system capabilities are not equipped enough to comply with all the IRAC norms. So more to do is they will generally give you a classification, or they will just give you the days past due, the DPD days. Now, there are other things which needs to be taken care, more to do with say there is a percolation. Same borrower may have 2 accounts, or the system doesn't have capability of classifying that. So certain other IRAC-related provisions which may also come into the picture while doing the ECL class calculation, or maybe if it's on IGAP also, the classification, the provisioning as per the RBI, we need to take up the entire AUM breakup from their LMS system and ensure the classification basis the DPD days has been done basis the IRAC classification into the SMA or an substandard or doubtful or loss category and provided accordingly.
Since we talked about harmonization norms and which has to be brought into the system, I would like to take up the point on the automation. So Ashutosh sir, as you have been on the board, so you are from the auditor side as well as from the auditee side, like from the both sides of the table. So what are your views on the level of readiness of the governance oversight on overall automation? Are the board members aware about, like, what's the level of awareness that the board members have on the overall automation part? What are your views on the same?
See, this industry, the way it has grown, automation is the norm. I mean, the industry cannot serve so many customers without automation. And one of the things when you are so heavily automated, if I'm speaking now as a board member, I also need to know what is the level of automation, what are the things which have got automated. I need not be a tech expert, I don't have to understand the software coding part of it, but I'm still supposed to be, okay, as an audit committee member, you're supposed to be financially literate. So those concepts, see, fortunately with all the automation and with all the changes in the world, the accounting principles have remained the same for 500 years. It's still debit what comes in, credit what goes out. And there's nothing wrong if a board member is not able to understand that automation. You can just tell them, okay, just you give me a comfort, write down the journal entry the way it is going to be captured in the software system. Let me be satisfied that this journal entry is eventually captured properly. I mean, nothing wrong, even as auditor and as a non-auditor also. That's the principle, at least I adopt. I mean, if there is a confusion of what a transaction is, and we all know NBFCs come up with exotic transactions and arrangements with different terminologies coming in. So you just slice it down to the bare accounting entry and then ask the same question now whether this accounting entry is captured in the system. Because a normal thing of disbursing a 1 lakh rupee loan might go through 7 or 8 accounting entries till the basic accounting entry of loan account debit to bank is done. And that is the expectation of the regulator also, because the regulator also do ask directors that have you all understood the control systems in the automated environment. I mean, that's very, very critical of knowing it. Yes, the overall governance is increasing on it. Like for banks, RBI has mandated that the directors themselves have to undergo a training. There are sessions at that IDRPT and all those kind of centers. I'm expecting that will happen to NBFCs also. By the sheer numbers involved and the population involved, these are public interest entities which RBI cannot ignore, and that process will go through. So there has to be a lot of heavy interaction between the board members, the preparers, which will be both the finance function and IT function. And also there will be one more element that the board members can ask the auditors, that have you all understood the system the way it is designed, and have you all got a comfort on it. And as auditors, we actually have played a role of kind of giving an informal training to the audit committee members in our audit committee presentation. I mean, not a separate task, because many a times we have experienced that when we have to explain an outcome of an accounting event, that outcome needs to be explained by coming down to basics of how the technology was used, what estimations were there, from where all they came in, how they went into the system. So I think that's one auditing procedure change which is for all of us to just keep on following.
So that means that we need not be utmost tech savvy people to understand the fancy automations, but we should be able to break down the things at the basics, at the golden rule level.
You just need to ask the right questions, whatever
right questions. Okay. So moving on to Saurabh sir. back in March 2025, RBI General, he emphasized on the auditor's scrutiny on controls on various critical areas and disclosure areas such as liquidity risk, credit risk, ALM mismatch, etc. What are your views on the same? Like what key points we should bear in mind?
I think credit risk is very well covered in the ECL process. So as auditors, once you look at the ECL year on year, quarter on quarter, or over a period, the consistency and spikes, if any, is what will make you understand the credit risk. I think apart from only looking at the models, now all the NBFC or any audit, I think the key factor for any audit team is sitting across with the client, and that should not be restricted only at the accounting level. So you have to actually go across all departments, sit with all heads of departments at all possible levels, understand the business. That is where you will really understand how they are looking at credit risk from a purely operation side, from a underwriting side, actual accounting side, which will give you a fair idea of the credit risk, what they are explaining to you as auditee, and what you are actually seeing when translated into numbers. Now this matching somewhere has to happen as part of the audit process. On the ALM side, I think there are various laws or regulations which are prescribed. Purely as auditors, there are disclosures which come at the year end. But apart from that, at the board level, there are separate committees which look into it on an ongoing basis, and which the agendas and the minutes will very clearly highlight as to where each company faces the mismatch. Normally, these are on the long-term tenures, where matching asset liabilities is a challenge for each company. And what is explained to you by the treasury teams in terms of how they are going about matching the borrowing side vis-a-vis the lending. Again, all these explanations over a period have to match to the numbers you get as auditors. So you cannot have an explanation which goes in a one line and one direction, and eventually when you get the financials, you see something different. So as auditors, I think many times we get restricted to either the CFO level or pure accounts team. So it has to now move out completely out of that department into various other departments. Only that is when you will know various nuances of the business and the actual on-ground things which are happening. And over a period, this mismatch in a way gets explained through the business as well as the financials which come up. So I think beyond that, as auditors, we really have no role to play in terms of if there is a mismatch, it's for the business or the management to resolve. Our job today at least is only to report and ensure that the norms as prescribed by the regulator are maintained.
Moving on to the next question with respect to the out-of-book entries. So Ankush sir, what are your views on what things we should bear in mind and what we should cover in our audit process to look after these scenarios?
So typically in an NBFC, out-of-the-book entries would include certain provisions or write-off entries or certain unreconciled adjustments which are required, or certain other fancy items which, as we are saying, the NBFC or the management can come up with. Generally, our role would remain the same as we are doing for a company. Whatever adjustments are out of the book or any adjustment has been taken, we need to make sure that has reconciled with the subsidiary general ledgers, mostly in case of NBFCs where there is no straight-through process between the LMS and LOS and the accounting software. This type of out-of-the-book adjustment entries would come. So there we will have to ensure the outputs from the LMS and particularly the AUM, the interest incomes, including the other processing fees and those. We need to ensure the reconciliation between those, conducts substantive testing, ensure that the maker-checker controls and whether proper authorizations were taken for this out-of-the-book adjustments, and should be highlighted at a proper forum also to ensure that this can be reduced for the future years, so avoid any manual errors or adjustments. So that is all majorly taken care of.
Since Ankush highlighted about the accounting software or the system, moving on to the next question is implementation of core financial services solution, which is akin to the core banking system, which we would all have heard about, which is existing in the banking industry. So Ashutosh sir, what are your views on the same? Like, is there any right way to adopt this implementation, and what could be the challenges that can come, that NBFCs can face while implementing the same?
See, again, we can learn from history, and that's when core banking solutions came in. I don't know, people over here may not be aware. Core banking solutions was not a requirement of RBI. It was a requirement of the parliament, which said that there has to be a banking system available for which a bank customer can bank from his remote village or from a city. That's how core banking started, and over a period of last 25-30 years, it has evolved into a solid technology platform. Now NBFCs again are, as I said earlier, they are dealing with mass numbers. So a core software will always be useful in terms of the discipline of accounting. So today, even without core banking, banks were required to prepare daily balance sheets. And that's been embodied in the BR Act again since whenever it was there. So same principle now if it comes to core financial software for an NBFC, we will definitely get murmurs from the industry players ki ye zarurat nahi hai, it is difficult, all that. And there are challenges. I mean, I am not saying there are challenges, but the industry's first reaction would be, is it really required? The date, which is, I think it's September 25 or March 26, yeah. So the date could be pushed ahead, but I don't see it getting pushed ahead for more than a year or so. It's time has come of doing it. The practical challenge, the software challenges are not there because softwares are common. I mean, whatever banks are using for retail solutions, NBFCs are using. So accounting systems are again the handful, 4 or 5 systems are there. They're all using it. Integrating it and creating a daily balance sheet is what core banking would be all about. Now, one may say that, do I need a time by time balance available for me as a customer of the NBFC vis-a-vis customer of a bank? Perhaps the answer is no. So you have that leeway, like I deposit a check in my account today or deposit cash in my account, I need updated balances, I have to pay him, I need to do something more. But in an NBFC scenario, because it's not a bank, these transactions won't happen. So that leeway is there. So from a software perspective, the resources required for the software hardware will be lesser as compared to what an NBFC would require. And that's how I don't see that as a huge challenge. The challenge will be the mindset of the people who have to implement it, because till yesterday they were not required to prepare a daily balance sheet, so to say. Now they will be required to prepare a daily balance sheet. That will take care of the question you asked him about outside the system entries. Automatically those entries, even if outside the system, will have to be passed on a daily basis. So the entire control environment would improve. As auditors, again, we need to go through that whole process. We are done bank audit, so we are aware of how a core banking solution works. I don't see many changes in audit procedures happening because of this. But for sure, there will be some backlash from the industry, which might result into a postponement of the deadline, but eventually it will be there.
Saurabh sir, moving on to the next point, which is on the IFC, Internal Financial Control Reporting, which forms a very key and important part of our audit report as a statutory auditors. So what are the key points we should be considering to ensure that we are covering the controls adequately, we are ensuring that the controls in place are mitigating the risk that has been identified? So what is the right approach to go ahead with the IFC testing? How can we adequately cover it in our audit process?
I think audit, I mean, as my seniors used to say, very funnily, your deliverable is ready on day one because it's the audit report. What starts and what ends is in between. So IFC is typically like your report is ready. Now how much you wish to get into it is the detailing of it. But typically, I think few things which we always ignore is that we presume it is there. So at least on a sizable company, if it is not there, it is always better to go and tell the audit committee it is not there, and then work with them to ensure that at least something is prepared and documented. Because now there are various shades to it with NAFRA coming in on the documentation side. You have to be absolutely sure. Most companies either will have an internal team looking into it, or they appoint external firms to help on the testing part. Having said so, as statutory auditor, your responsibility is 100%, no matter if someone does it or doesn't do it. Even if some external firm does it, you still have to do it, and it's your reporting which will matter. Only thing is, if someone else is doing it, you can use that work to either enhance, change, or modify your work part of it. But over a period, what is seen is that if you go back to the audit committee and tell them that these are the things which are missing or shortcomings or need to be done, most of the audit committees are responding in a manner where they will push the management to get it done. And in the long term, it is always helpful as auditors to have it in that fashion, rather than presuming that they know that it is not there and still you are reporting. So definitely over a period, that documentation forcing onto the management is the only way it will help the auditors. On the audit part of it, each company will have its own sets of documentations in various forms. Typically are the SOPs, the RCMs, the control metrics which are in place. So you test them as part of your audit process, be it quarterly or a yearly, and then report to the audit committee. But I think going back to the audit committees and very specifically saying that these things need to be improved has shown results in most of the companies, because the fundamental responsibility is still with the management through the director's report to say that it exists, and we are only in a way reassuring it that through the audit report. So it is not our primary responsibility, it is actually the director's responsibility to ensure it is in place. We are in a way reporting it exists, and if it doesn't exist, then we also have the leeway to report what is not existing. So we should not take it as our primary responsibility, and that is where informing the management that something is not there, I think will help in the long run.
If I can just taking a cue from him and going back to the earlier question on core financial systems, that will also play an important role. The whole IFC, ICFR part of it, in a core basis, how it is getting addressed. Because today, if it is not there, I'm used to doing ICFR testing over a period of time. Now, am I required to use as a management some automated tool which will give the comfort on a, if not on a daily basis, at least on an ongoing basis? Anything going wrong should be flashed up immediately. Those are aspects which will change with the core financial system.
Extending the point which you highlighted, Saurabh sir, related to IFC, wherein the NBFCs can either do it internally or appoint some external firm. Ankush sir, what is your view on the level of reliance that as statutory auditors we should place on the internal work or the internal IFC framework that the NBFCs will have? Like in case of lack of governance or lack of risk-based internal audit approach. So in such scenarios, what key issues can come up and how can we highlight the same?
So I'll break it into two. One is whether the management has performed the ICOFAR or they have done their own management test of controls. Obviously, we can, as Saurabh rightly said, that we can put a reliance on that, but we will have to do our checking as well for all the RCSs or our RCM, whatever we call them. So, which should necessarily include not only the controls which are related to the operations, but more to do with the financial reporting aspect of it, which includes not only the TB level of checking, but also to the extent of the notes and the disclosures which are being considered, and also the entity level controls and the ITGC controls embedded within. So, sir rightly said that if core banking is there, then this will also be getting automated. So your ITGC controls then becomes a lot of importance over there. And the second part of it, if it is non-existent, then what needs to be done for us as a statutory auditor? So in those cases, I think the RBI itself says in case of asset size of more than 500 crores, independent internal auditor needs to be there who should be reporting it directly to the audit committee or other forum and should be independent of other functions. So in those cases, if it is not there, obviously one should be that we should be asking the management to implement the process. And if it is non-existent in that case, we should be doing substantive testing more from the compliance perspective and looking at whether the entity level controls or the compliant risk is taken care altogether. And obviously our reporting on the ICOFAR, which is an important part, which we take care from, which help from the internal auditors basis also, or management test of controls. That also needs to be done as substantive testing, so as to ensure that whatever compliances or other manual adjustments, as we spoke, have been a proper maker-checker, or at least they are adhering to the internal policies and the SOPs which the management has.
Moving on to the next question, which is for all the three of you. What are your views on the issues or the key concerns which RBI has highlighted? Like in past 2 to 3 years, there have been many enforcement actions which are taken on the NBFCs in multiple areas, be it KYC compliance, fair pricing norms, loan documentation, fair prices by recovery agents, delayed fraud reporting, credit bureau reporting, etc. So there have been multiple, from smallest to biggest areas, which the regulator has picked up, where NBFCs would have lacked in compliance. So as an auditor, as a statutory auditor, what key concerns we should keep in mind to avoid any repercussions on our side? And what are the expectations of the regulator from us?
So expectations by the regulator, or as we say SSM in our normal jargon, the senior supervisory manager, whenever we have interactions with them, is, or whenever there is a meeting of the statutory auditors with the NBFC or the banks, their expectation is for the statutory auditor to comply with, to see that the bank or an NBFC is complying with each and every regulation which RBI is given. But accepting that blanketly is also not our role, because if we are a statutory auditor, so things have to be looked upon what we are supposed to be reporting as part of our audit report, or which have been given to by the Reserve Bank of India from maybe as a part of our additional report, or any exceptional reporting which we are supposed to give to the Reserve Bank of India if anything gets highlighted. Now suppose during our audit we come across certain things which I think most of the auditors miss, maybe is non-compliance of IRAC norms or certain KYC norms, and IRAC norms at whatever imputation. So exceptional reporting is what we can maximum expose to, and we can obviously report it to the Reserve Bank of India through both, it is through the CIMS portal also, where we are supposed to report that, and also additional report as an exceptional reporting which we can take care of that. Now other compliances, whatever which is from the Reserve Bank point of view, is if it requires any audit adjustment, whether the management is taking with it as part of an audit adjustment or management adjustment itself, and that we should make sure that that has been taken care within the books of account on.
I mean, the usual thing which we hear is that the regulator's expectation of us is literally sky high. So having said that, in a regulated entity, let's assume that you are not a regulated entity, would you be looking at KYC norms while doing an audit of an NBFC? There is no regulation. I think those are the answers which we have to find out ourselves while doing an audit. To what extent we would have seen these kind of things on which the regulator wants us to have a look at. Those are given, those we have to do. A fair practices code violation, it has no impact on financial reporting. Had fair practices been followed, the profit would have been this and not reported. What is that? I mean, I don't think we are required to do that. But at the same time, the regulator wants us to have a view on it and give it. In banks, at least it's easier because we have a LFAR which is there. Other entities, we don't have an LFAR. Having said that, I think as a body, and we are here in the institute's premises, as a body, we also need to thoda sa educate the regulators of their expectations from the audit function. I think that is something I feel, personal view, which we are lacking. We need to tell them what is an audit. Actually, the institute has a old publication of what is an audit. I don't know whether it's available right now. It's a 1970s publication. In a very nice way, they have defined what an audit is. I think we have to go back to the basics and do it. But that's a parallel, like in those Korean serials, you have parallel universes. That's a parallel universe. Our universe is that these points which you have talked about, we still have to report, and how best we report it is what we have to do it, but again within the framework of financial reporting. I mean, that's something. I mean, one usual thing which I've discussed with SSMs also, that they want us to report about number of complaints. Now, as an auditor, I will never ever get a comfort on the completeness of that number. At least for accounts, I have a comfort on completeness because it's a transaction which is getting recorded. But number of complaints will always be from many systems, many inputs which are coming in. Somebody collates that MIS. Literally, we are reporting on the true and fair view of the MIS. Nothing else. Those are some things I think as a body we need to communicate. And perhaps that might change the view of the regulator. I think it's a utopian thinking on my part, but it might change the view of the regulator that perhaps we should let the auditors focus on what they're required to do rather than reporting on these kind of numbers which we are talking about. Easier said than done. I don't know whether it will happen ever, but that's my wishful thinking.
Saurabh sir, any views you would like to add up?
I think, as Ashutosh rightly said, see, primarily our focus always used to be on the financial transaction part of it. But going to RBI, typically it has practically rules for all sides of the balance sheet, all sides of business. So now what they're expecting the auditors is to report on all possible circulars that have been issued. And many of them are either at the operational level, customer facing, or very minuscule kind of a thing. But they expect that as circular is issued, everything goes back to the statutory auditor. So somewhere that trade-off in terms of time availability and actual work does happen. But as Ashutosh said, it is finally how you go back to the regulator and tell them that does it affect. See, because in banks when the inspections happen, typically there are these adjusted numbers which come in. NBFC has nothing of that sort. And the main reason is the ECL, which is in a way covering many things. But so now the focus also of RBI is shifting in the inspections of NBFCs from typically the provisioning to all other aspects of their own circulars. And that is where over a period, as auditors also, you will keep on understanding what they are trying to focus. They will always outsmart, but we have to keep in pace with them.
I mean, in a recent experience over the last couple of months, one SSM asked us that why has this entity declared dividend? So, and they wanted an answer. Fortunately, they didn't capture it in the minutes. But the answer was that we have not asked why. We are not required to ask why. That's a business decision. So far as that why, after that why the still CRAR is maintained, all the how part of it is looked at. Companies Act, RBI requirement, post dividend declaration, going concern is not an issue, blah, blah, blah. Wo sab ho gaya. But I think that's where we need to kind of go back to the regulator and tell them, look, some things are beyond us. We wouldn't want to go in that terrain. Or rather, we are not required to go in that terrain.
Since we were all talking about compliance to various regulations, picking up one of them, which is Fair Practice Code. So Saurabh sir, what are your views on the implementation part of the FPC? Because that has led to revamping of entire internal policies, systems, training to the internal employees, customer communication and IT infrastructure. So it has got a multifaceted impact on various aspects of the NBFC's operating cycle. So what are your views on the same, and how can we cover FPC compliance part in our audit?
See, I think one of the key things which currently in inspections is coming out is the implementation of the various parameters on the FPC, that is the Fair Practice Code. If you look at the Fair Practice Code, it is right starting from the customer onboarding till the time he is actually moving out. Now, you really have to break that into the various aspects which can correlate to audit. So if you see the fair practice, there are various things which can be correlated to the lending part of it, the actual customer interaction, and the documentations. So over a period, the regulators have started going into very nitty-gritties on the documentation aspects also with respect to what actually goes to the customer. And that sometimes becomes interesting because what is spelled out in terms of rate of interest, what is said to be the repayment periods, and what is actually being translated through the hard copies of the loan agreements. Now, as auditors, we sometimes stop at the basic numbers, figures, and translation into the financial statements. But these are the aspects which they are now getting into lot of details on the, at least definitely on the NBFC part of the inspections. So these fair practice code, I think it runs into numbers, but you will have to basically bucket it into various areas of audit and try to match it to your audit procedures wherever possible. Because through that, there are a lot of things which do come up where the actual transactions vis-a-vis what is defined and what is stated. There are loopholes which even you as auditors can point out, and which now the management is also well aware that the maximum penalties are being levied out on the fair practice code implementation. So most of the managements are very keen to correct them if highlighted. So over a period, the audit procedures have to be modified, and on a continuous basis, the regulators do keep on coming out with additions to these fair practice code, either through a formal circular or through various advisories which keep on issued. Like the current one in the housing finance companies are the various charges you can levy, you cannot levy, whether you can collect. Now, all these can be easily modified into your audit procedures to ensure that you are able to verify, and it also has a financial implication in many cases. So I won't say it is easy to cover the entire FPC every part of time, but you will have to be diligent enough to see what will matter first in terms of the financial impacts, and then more on the customer interface.
So regulator did come up with one more regulation back in 23-24, which was digital lending guidelines. So NBFCs do tend to outsource many of their activities, be it a critical or a non-critical part of their entire operating cycle. So any non-compliance by the outsourced partners could have a potential risk on the NBFCs. So as a statutory auditor, how we can cover up this part of area in our audit process? And what are your views on the same?
Mainly what NBFCs take for the outsourced partners would be the loan service providers, so which are covered by the digital lending guidelines, and also sometimes they go into the model of FLDG, which is also a DLG or default loss guarantee guidelines which RBI has come up. So as an auditor, mostly for an outsourced service provider, like in bank, obviously we don't have, as Ashutosh said, we don't have an LFR, we can comment upon the outsource, and we are required to comment upon the outsourced services which the bank has taken. But more so with the FLDG partners or loan service provider fintechs, where RBI guideline says it cannot exceed more than 5%. So within that, what we need to see is whether the SLA agreement or the agreement which is there, what it does not say anything beyond that, beyond the 5% would be guaranteed, or any deposit which can be taken by the FLDG partners. We also need to ensure that the FLDG partners are also regulated entities now, so this cannot be non-regulated, non-fintech entities, so that is also of utmost importance which we need to see. And obviously in ECL, when there is an FLDG partner, minimum 5% of provision which needs to be taken care. So financial impact from that sense is that is a major financial impact which we need to see. Other than that, the loan service providers, from an audit trail point of view, is what we need to see, because the loan service providers would be fintechs who will, and the audit trail and the control and what data is being exposed to them, and whether the audit trail related things have been implemented within this digital lending platforms, and what data sharing is happening with them, and what is the control and other ITGC controls that needs to be taken care of.
Since we talked about the outsourcing activity extensively in our prior question, the another major activity which is generally outsourced is the collection part. So, Saurabh sir, what are your views on the same? Because there are many malpractices which generally occur in the area of collections.
Very frankly, as auditors, our role is very restrictive on the financial part of it, in terms of, so typically what you can see is, one is the collection costs which are actually incurred. So companies do actually hire various agencies for collection, and it will be collections at different stages. So in the normal course, the collection may be more in terms of prodding the customer to pay. Post NPA, these are specialized agencies which get into the act. So as auditors, I think it's to see whether these costs look abnormal period on period, year on year. But beyond that, as auditors, I think we have no role, unless the other aspect is, I think as earlier mentioned, the complaints which come in. So complaints coming at various levels, either through whistleblower or the complaints portal of the NBFC, there the classifications are available. So if there are any complaints on the collection part of it, that is where you will have to sit with the management to understand the nature, because many times it may happen that suddenly that thing goes blown out of proportion directly into media, and you will practically come to know only parallel to that. So you as auditors very rarely will have a situation where you know in advance. So more or less when it blows out is only time when you will come to know. So as part of audit, I think beyond that, there is nothing much which can be done on this.
So we talked about many activities and processes. One of the sensitive area, which is the related party transactions. So Ankush sir, what are your views on the governance part of it? Like how can a statutory auditor cover this sensitive area during their reporting aspect?
So related party transactions, I think now the SEBI LODR norms have also changed now, which will be becoming effective from 1st September, will be effective from this 1st September now, 2025. Related party transactions, the base always remains the same. There is an RPT policy, whether it has been approved by the audit committee, the transactions related to the related party. Now with that SB LODR coming into picture, the related party also needs to be classified. Maybe it has to be comprehensive or a limited disclosure or a material or disclosure, depending on 2 or 3 aspects, basis the materiality as per the materiality policy of the company, or basis the turnover or the net worth of the company, or basic threshold of 1 crore rupees, which has been defined in that SAB LODR, so as to ensure there is a transparency and the disclosure on a basic standard has been, for a listed entity, has been complied with. Other than that, of course, the India's 24 and the 18 related compliances is what needs to be taken for, in addition to the arm's length and the disclosure as required, or maybe comprehensive or minimum that needs to be disclosed.
The next question is for all the panelists. So what are your experiences while dealing with the audit committee members? So for Ashutosh sir, it is like 2 sides of the same table. But
so
yeah,
I can't criticize either then.
So you have to decide which side you have to take.
Well, which side is, I'm an auditor by heart, so that goes without saying. But yes, I mean the interactions with the audit committee, firstly as an auditor, is quite varied. Over a period of time, things have settled down in a routine where the audit committee also gives you time. Earlier, there used to be occasions where audit committees used to say that we are running short, 10 minutes mein khatam karo, whatever. The change in governance requirements has helped. The practices of meeting the audit committee without management, I think, is really useful because things can be discussed in a much different manner. And the inputs which come from the audit committee are also useful because, see, ultimately the audit committee is also a committee of the board, so they drive the business and they give you a business sense which comes in. So those are quite useful things. But one of the things which I learned very early in my career was, and which I think amongst audits even today, lack of availability of data in time. So I still remember about Saurabh Chitale said ki there was no audit committees at that time, only the board. He said, let's go and tell the board that things are not coming in time. So we felt, how do you take this issue to the board and tell them? But it created a difference by just saying that yes, we needed information on time. Things then develop. So I've seen that curve. And the interaction with the audit committee is quite useful. You can tell them things beyond what you are presented in those many words. Numbers are discussed, and now in a UPSI environment, it is all the more important of how those numbers and understanding of numbers which are there. Somewhere you also have to draw a line. Like there was one bank where the audit committee chair said that I would like you to present the numbers in your presentation. And then our joint auditor said, no sir, we can't do that because at audit committee, the accounts are still not adopted. So if we put those numbers as a management thing, it would perhaps be an UPSI issue. So the numbers have to be presented by the management. We will come in with our matters arising out of audit the way the standard is. So that's really useful. And as, again, wearing the hat of an audit committee member, I think we should encourage interactions with the auditors in the committee, outside of the committee. You have to be available to the auditor whenever required, not just because it's a governance thing. Because for the audit committee, an auditor is also a source of information, which can then be collaborated with, I wouldn't say cross-verified, that's too large a term, but collaborated with what the management is telling the board, what kind of soft issues which could be there. Overall, I would say, period of time, it has become a much healthier interaction between the audit committee and the auditor.
So your views on the same?
I think I concur. Over a period, I think what all auditors have realized, going and informing the audit committee always helps. Especially in the regulated, the added advantage is as the regulators spend time with auditors, they are also spending considerable time with audit committee members. So the audit committee members are also equally aware of what is being asked and what is the, I would say, the importance given to various things forming part of regulations. So most of the suggestions or things you will put across will be taken in the right spirit, and these informal meetings with the audit committee members or the audit committee chair is a good platform to put forward whatever views you have, both on the operational as well as the actual financial part of it.
So I agree that the audit committee part is actually that TCWG which we say it is that forum. So those charged with governance, that is the communication, and it is that forum where we also, as part of our auditing standard, we say whether we had the access to the audit committees or not. So that is also one thing which is there. The other thing where we said that we don't have access to the LFAR like we do in banks, but we have, in case of NBFCs, is audit committee to whatever suggestions, like we discussed whether there is no risk-based internal audit is not existing, or we feel these things are not automated. Those type of suggestions can be communicated via the audit committee, and we have communicated those to the audit committee, and we have seen that those are getting implemented. So by passing time, so it is a very good experience which we had with the audit committees. And even in our experience, we have seen whether we had any difference with the management of any opinion we wanted to give in our audit reports. The audit committee have always supported the auditors in taking our view ahead, that why this needs to be taken then and that, because the person sitting in the audit committees, they were somehow the other time like, sir, or on the other side, the core auditing people. So they understand why, from what view the auditors are coming, while the management would only look at from maybe their market point of view or their investors' point of view. So that ways our interactions with the audit committees have been really good in the past 2 to 3 years. This has changed very pragmatically, and what we disclose to them about the management estimates or the judgments or whatever mandatory communications which we require as part of our audit committee is always being heard, and due care is being taken for the next time if anything required.
So you all three did talk about your personal experiences with the regulator in some of the prior questions, but anything you would like to add up as a concluding part, any special points or any critical aspects which the regulator is on the top of the toes, and as an auditor we should be mindful of the same?
Again, when this interaction with the SSM started at the banks first and now at NBFCs, I think there was a hesitancy on both sides. We were hesitant of how much to talk, they were hesitant of how much to direct us. It was quite noticeable because that wavelength had not matched. And our initial first few interactions with SSM, and they might have had the same experience, was that really we used to make a list and then eliminate from that list so many things which were there. But again, now it's almost 4 years since SSM interactions have started. We have become more open, both sides, auditors as well as SSMs. They also give a lot of guidance. Of course, they give directions also on certain things which they would want us to verify and give it to them. So those aspects do come in. Sometimes they would request a formal report to be given to the auditee entity, and which gets forwarded to them. Sometimes it's just an informal feedback on certain performance or whatever it is. So those things have, again, I think we have settled down. We understand each other now. That's been my experience. We are quite open. I mean, it's quite understandable of if they have a particular concern, because they have a view of the industry. We will not have the view of the industry. They will have a view of what's happening in some remote geography location, and that might help you. I mean, you have an entity which, let's say, has an exposure in Assam, and they can tell you, I mean, it could just be a normal conversation without any particular intent on the SSM's part. They will tell you, this has been RBI's experience of certain portfolio behavior in a remote district in Assam, and that can help you in your audit process. And these things have really helped. So yes, the openness is much more. Initially, they used to, I mean, I still remember after the first SSM meeting and the second SSM meeting, they actually chided us कि आप लोगों ने जाके बैंक को क्यों बोला? What you and I talked was confidential to us. So then we had to explain to them, look, if I don't talk to the bank, the information which you want, I will not be able to give. I have no access to their internal things. So those things have gone by. I think we know each other well, and honestly, we look forward to an SSM meeting, because we also come to know, rather than 1 year down the line something happens and you will get a newspaper report of auditor being hauled up. It's better that the SSM tells you these are the pain points either in that entity or some other entity, and you please have a look at it.
Saurabh sir, anything you would like to add up to the same?
I think, as Ashutosh rightly pointed out, now with the SSM, the added advantage is that, see, typically you have that NBFC to report to, but for them within NBFC, again, now there are sectoral NBFCs which operate. So they have a lot of data which we don't have, and they in a way more or less tell you that in this type of industry, this is what is seen on an overall basis, but we find this to be missing or different in this NBFC. So there are a lot of, I would say, precursor kind of a thing which they point out to you as auditors, which you can very well either correct or implement directly. And the other aspect over a period is what is seen is now they have also started discussing with the auditors on the business aspects of the NBFCs, and they have very point blank questions on why this business was started or why it is being done in a particular manner. And as auditors, typically we are never used to answering them, because we don't look at any audit from a I mean, we will look at the profit or loss, but we would not get into was it required to be done or not. Now they in a way combine the CAG plus the regulatory aspect in the discussions. Fortunately, they have not yet been documented. The minutes get documented, but some of these questions don't get. But they have been asking questions on the specificities of those entities, the businesses, or the decisions taken. So some of the questions remain as more of a guiding, but it definitely helps because it's more like an early warning signal to the auditors that prior to the next audit, these are the things which either you need to tighten up or be more careful of going forward.
So, Saurabh sir and Ashutosh ji, मतलब एकदम detail में whatever is required from an SSM meeting is obviously being captured there. The only input which I have or from an SSM meeting which I come when we come out of that meeting or whenever meet is obviously from a fact that RBI looks probably from, as Ashutosh ji rightly said, on an industry point of view, and we are looking from a particular specific NBFC point of view. So that does help us. And one more thing which they always say is any interpretation which we are differing or any interpretation which we want from RBI, what they exactly meant, can be discussed in that SSM meeting. We may or may not get the reply, but at least we have put forth our point of view, what we believe from the particular interpretation or what was required to be done. But in past, we have also seen that there is a bank directing us to specific things, like the ROU thing which was not required, which was initially not, before the circular came, we were reducing it from as a intangible asset, we were reducing it from the net own fund until the circular came in March itself to not reduce it. There is a bank was directing the companies and so we were helplessly even in our other NBFCs also doing it, even though there was no specific direction, but it had given direction to one of our NBFC, so we had to indirectly do it. So those types of things we can, whenever there is an SSM meeting, can have a discussion with the particular SSM of that particular NBFC, whether we need to take such type of interpretation or not. So that has helped in case of one of our NBFC that is luck by chance if they reply, so that would be a so that is.
So before we conclude our panel discussion, I would like to invite questions from the audience if they want to clarify anything or any questions particularly to the panelist. Seems the questions that we had covered all the queries everybody has. Okay, you have the question.
After all, ECL is an accounting estimate. We got to follow the principles of how we audit an accounting estimate. So if something is amiss, it's not as per the business, or the statistical formula used is not proper, you can always challenge it. You have to hear the auditee out and then come to a conclusion whether they are right or wrong or whatever any adjustment is required. I'll just elaborate by a story which is actually 4 days old. Where June quarter results are going on right now. Because now ECL has become a function of the risk team. The finance team comes later on. That's again an evolvement which has happened in the industry. So when we are talking about this ECL changes to be done and all, the risk guy said, no, it is my prerogative. I can change ECL on a monthly basis if I want. I have to look at my micro level things and then change it. So our rebuttal to him was, if you are really changing ECL on a micro level basis, are you changing the pricing of your loan? Because if your environment is so dynamic that you need to relook at your model and change inputs on a monthly basis, means your business also is equally dynamic and business is moving. There was no answer to that. And eventually we are now going ahead. The results are not yet out. It is UPSI, no numbers disclosed. We are going back to what they followed in March. So that is how we also have to step up and ask questions. And another thing what we need to understand is also the statistical methods. I mean, we have to study ourselves and understand not just the jargon, but the formulas being used and the concept behind that formula. I mean, after all, everything is computer driven, so it comes in. That we need to understand, and that works actually.
So my question is relating to the write-off. The write-off the NBFCs are taking vis-a-vis how that can be collaborated in the ECL model. And the second part is the aggressive write-off that were taken in the previous year by many NCs. Like, how can that be collaborated or adjusted in the ECL model itself?
Two aspects. Even the write-off which is taken by an entity is to be based on the write-off policy of that entity. So it cannot be arbitrary. I don't like Saurabh, so I'll write him off at 120 days, and I like Ankush, so I'll write him off at 360 days. I mean, both I'll write off, but at two different patterns. It has to be objective. There has to be a write-off policy again, and that policy will take away the argument of bias that I'm doing write-offs to manage my profits. So once that is done, the write-off history does come into your ECL computation. And even if a write-off is done for technical purposes, taking some tax benefits, it has to flow into your LGD, because that's a loss after all. The action of write-off, even for technical purposes, means the management and the board is saying that this money is now no more recoverable. You will also have to factor in the recoveries made from the write-off, return of amounts. That also will be a factor which will go into LGD and hence into your ECL computation. Why not? If that loan is bad, from a financial reporting, it can be written off. From a governance perspective, whether the person still needs to be a director or not is a different thing altogether. It's proxies can be taken. So the standard permits you to look at proxies and take that. So if I am in a particular business, I lend to a particular class of customers or a class of business, I'll look at publicly available data and take it.
So can I take IRACP norms as an ECL norm?
No. Fundamental difference, IRAC norms are incurred loss, ECL is expected loss. Sorry, didn't get the question.
Digital funding, how they control it?
You're talking about whether digital loans, how the banks control, or maybe for that matter, how NBFCs control it. No, so if the question is from the KYC point of view, digital lending, it can happen, you can do it in 5 minutes now, what that NBFCs has within embedded. What they will do is, aapka Aadhaar seeding ho jayega very easily, right? So there is a video call, video KYC and those things. So there are directions within that it has to be double checked. One initial internal approval from the management would be there, and then a concurrent or an internal auditor of the bank or an outsourced agency would be also verifying that particular fact. Then only the loan would be created into the system. There is a video KYC and those things for the digital loans is how it is being done by both the NBFCs and the banks. So there are parameters which is embedded within the system whenever they are doing. So whenever you go for a digital loan, that will happen from your Aadhaar and your PAN card. They will verify whatever loans you have taken in the past, what are your default things, what is your CIBIL rating, and from your access, and when you will give them rights about the bank accounts, so they will download the bank accounts. Within 5 minutes, they will download verify all these things and give you a limit. Yes, you are eligible for 10 lakhs or 2 lakhs, 3 lakhs, depending on that. And when if you accept it, there is a digital signing which happens. So if you click on yes, your sign and everything will be coming directly from your video KYC and things, and it gets disbursed. So सब चीज़ मतलब वहाँ पर IRAC norms भी IRAC मतलब fair practice code, आपका interest rate basis your CIBIL score, your basis your eligibility, everything, the interest rate and everything will be decided. So it's all system run backend पे, and everything can be done in 2 minutes. That is what NBFCs are doing now.
Question from my side. This is regarding the presentation in the financial statements of the NBFCs. Basically, this is regarding the disclosure of the interest accrued on the loans and the standards or the non-performing provisions what we are making. Should we show it as a part of loan element only? Because we have interaction with the SSMs only. We have 2 interactions and both are having contradictory views. So should we form it as a part of loan and then show the less provisions, or should we show the provisions separately?
So I'm assuming this is in Ind AS.
Yeah.
Yeah. So Ind AS में amortized cost में interest को साथ में लेना ही पड़ेगा. So we will have to, if it is being done on an expected interest rate and we are amortizing over size, so it will be including interest, and for that matter, as part of ECL also we will be considering it including the interest, and then the provision needs to be reduced.
So provision has to be reduced from the loan disclosure itself, not
Yes.
to be shown separately. Thank you.
Hello. Sir, in case of buyout portfolio, where my portfolio consists of different stages of ECL, like 1, 2, 3, so do we need to apply ECL at a portfolio level, or we need to assess individual loan in the portfolio?
It's a buyout portfolio. I'm assuming it won't be more than 60 days DPD, तो वो होगा नहीं, right? So it has to be a standard portfolio when you are buying it out. Once you buy it out, it cannot be looked at a portfolio level. It becomes part of your overall universe. So then it has to fall within your whatever ECL model is there, and it has to be adopted independently to each of the loan within that. The portfolio, if at all the portfolio is a separate type of loan itself. Suppose the NBFC is dealing only into what we say vehicle loans, but you have buyout certain LAPs, then you can obviously apply a different model of ECL to that. But if it is a vehicle loan buyout only, then whatever ECL model was there previously needs to be adopted to all the individual loans. It cannot be adopted on that particular portfolio which we have bought, because your basis remains the same as we were discussing. The overall methodology or overall the loans which we are disbursing, so the credit risk is embedded within that whenever we are buying it out.
So concluding with today's panel discussion, I would like to thank all the 3 panelists for such a wonderful discussion, very interactive session, and for the audience to bring out practical questions and practical queries which they had. It was really wonderful to interact with all 3 of you. Thank you.